Hello everyone, this is Mulham, and in today's video I'll go over a full guide and explanation to ICT Advanced Market Structure. What is a long-term, intermediate term, and short-term swing? How do we determine them and how do you use them? This video is one of the most important videos that you'll watch if you're marking a wrong change of character or breakout structure. You're always stopped out and your point of interest or PDRA is not respected and holding, or you're always missing trades. You gotta watch the video till the end. Make sure you do, as I will try to put everything together for you at the end of the video. If you guys like this type of content, make sure you subscribe to the channel and join my free Discord, link at the description. Let's dive in. So I'm gonna go over a quick introduction first, and then we're gonna cover long-term swings, short-term swings, and intermediate term swings. I'll start with long-term and short-term because they are kind of related to each other and they are the easiest, and we're not going to use them that much compared to the intermediate term swing. So we'll make sure we understand the first two first, and then I'm going to go to the third one, which is the intermediate term swings that we're going to depend more on. So first of all, interbank versus retail method of analyzing the market structure. When looking at this, we have the retail method, which is a higher high and then higher lows. Every high, when price is making a trend line with higher lows and higher highs, we mark them thinking that price will keep going up. That's how retail method works. However, this is not how the interbank seeing the chart. It's not this way. The market is going to be seen as liquidity and fair value gaps. So we want to see price rebalancing fair value gaps and price seeking liquidity. And we're gonna have three types of swings instead of higher high and lower high and higher lows and those stuff. We're gonna be having a long-term swings, a short-term swings, and an intermediate swings. And the most part is the intermediate high swings. And the most part is the intermediate term swings. So failure to understand market structure like an interbank trader is going to lead you to fall victim to false market structure breaks or change of characters. Most of the time, if you only trade based on the last swing and you think that price will make a change of character from here and your fair value gaps that is here is going to be respected, just because of this, you're totally wrong. So you really need to understand what type of swing is this. Is it a short term, or is it an intermediate term, or a long term? So you know if it's a valid change of character or no. So after this video, you'll understand. So after this video, I'll teach you how to avoid false change of character or market structure shift. So first of all, long-term swings, either long-term high or long-term low, it is when price is moving and approaching a resistance level, either a fair value gap or an auto block or a sweep. It can also be a sweep. When price reach this level, it shows a big reaction and price aggressively go to the other side. That's when we consider this as a long-term high. What's the condition? We need to have a higher time frame. This high needs to be on the daily or the 4-hour time frame. And most of the time, this movement right here is going to cause this break in market structure, this change of character. And after that, price will retrace and give another breakout structure and multiple breakout structure. This high right here is going to act like a shield. It's going to protect you. And this long-term swing is going to give you the narrative. So when price confirms this high right here, if you were bullish before and then this high confirms right here on the daily or the 4-hour, you need to change your narrative or your bias. So at this point, when it's confirmed, then you need to switch to bearish. Banks and financial institutions operate on monthly, weekly, daily chart. This means that large institutional liquidity is found on these charts. IPDA will want to be seeking large institutional liquidity. That's why the higher time frame is so important. We need to focus on the higher time frame. And I would suggest focusing on the daily or the 4-hour for this type of swings. Now, if you take a look at this, what we see here is we do have this auto block here with a fair value gap just right here. We mark this, and this is the daily. This is GU daily time frame. So price was approaching here, give us a nice candle here, and then goes down almost 1, 2, 3, 4, 5, 6, 7, 7 red candles or bearish candles out of 9. Change of character right here. That means this is now a confirmed long-term high. So now I'll be switching. If I was bullish here, after I see this, I would be more bearish. Price come to this fair value gap, fill this fair value gap, goes up, then react from this area. I would come back to this picture right here because this is an intermediate high and I'll cover it later. But most of the time, this long-term high, there is a big reaction from it aggressively to the downside, and it's always ended with a change of character and multiple breakout structure. You see a change of character here, price back to come to a point of interest to enter, goes down, give me a breakout structure. Price goes up, mitigate a fair value gap here, and then breakout structure. And we can see clearly that this now is a protected high. It will never be broken unless our analysis is wrong. And similarly, I gave you an example for a point of interest. It was an order block with a fair value gap. Now it's the same thing, but with the sweep. So we had this low right here. There was no order block or any other point of interest right here. So price reacted into this fair value gap here, goes down, but then here is a sweep with a wick on the daily time frame. Sweep with a wick, followed by a change of character just right here. And I'll cover on the next slides why this change of character is very strong. There is something that is different in this change of character than other swings. It's not only the last swing before the sweep. There is something else. And then price goes up into the fair value gap again, and then a breakout structure. And you see there was a breakout structure here too. Now, if I look into the short-term swings, either short-term high or short-term low, there are normal swing points that has liquidity above and below. Always liquidity above and below. You will see that those points are not being rebalanced. Like they don't go to a fair value gap and react. Not a fair value gap and react. Like different, like imagine prices going up, 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 up without a fair value gap to the left, and then it goes down. That means it builds some liquidity above. That's now a smart money move. It's a retail move, okay? So a lot of people will have their stop loss here. It's gonna go down, but eventually, this is a short-term high, this is a short-term low. Eventually, price will take both sell side and buy side liquidity. See here, this buy side liquidity is taken, and then after that, price comes down and take the sell side liquidity right here. That's always going to be the scenario. At least one of those sides, if not both of them, are be taken. An example right here is we have this short-term high. See price just went above this high, and then price comes down, creating this short-term high. And similarly, we have this short-term low. This is a sell side liquidity now. Below this, there is a liquidity. Above this, there is a liquidity. So what do we expect? A sweep here. Liquidity is taken from this short-term low. And after that, we can see here price goes up, sweep of the buy side liquidity or the short-term high. That's always going to be the scenario. We're only using the short-term swings just for entry. No narrative, no framework, no structure, nothing. Just for entry. We're going to switch to the lower time frame just for entry. So this is not really related to the market structure, but I wanted to mention this is that when we have a liquidity, that's leading to a turtle soup or a liquidity sweep. Liquidity is always taken. How is it taken? It's a liquidity sweep. It's a turtle soup. And most of the time, I've seen this pattern repeating over and over, and you can take an advantage of this. When you have price going up, leaving a fair value gap here, and then price comes up, creating a short-term high. What does that mean? There is no fair value gap here. There's nothing. It just price come down. Okay, price comes down, creating a short-term low because the fair value gap is right here. It's not here. It's just below. So price does not mitigate the fair value gap. Even if it does mitigate the mitigation block, still I want to see the fair value gap. Price break this short-term high, creating another one. That means we have more liquidity. even though this liquidity is taken, but we have a higher target. Even if it comes down here and I would want to buy, I have a higher reward to risk ratio. So basically, price comes down, takes this short-term low into the unmitigated fair value gap, and price always gonna go take the short-term high. Why? Because we already discussed price takes the short-term low, it takes the short-term high. Price takes the sell side liquidity and it goes to the buy side liquidity. That's what's happening here. When price comes here, it creates an intermediate term low. When price comes to this fair value gap, it creates an intermediate low, which means that now I'll know that I'm in the right structure. So this is a wrong structure here. This is not a change of character, but it is creating this intermediate term low. And price will go up. This is only a sweep. It's not a change of character. That's what a lot of people consider this as a change of character when it's really not. If you pay attention to the short-term high, short-term low, and intermediate term swings. And now comes the most important part, which is the intermediate term swings, high or low. So intermediate term swings, it can form in two ways. I really want you to focus on the second form, but you should also know this form, okay? Because it's related in one way. Basically, what I want to see is a short-term low made here. Price give a retracement, no fair value gap here, nothing. Price comes down again and goes up, most of the time breaking this high right here, the swing high. Price comes down, doesn't break this, and goes up from here. Now, it's basically a short-term low in both sides with an intermediate term low or a swing that is an intermediate term low in between. This is the classic intermediate term swing, okay? Two short-term lows that has a swing in between, and this is an intermediate term low. On the other hand, if I want to look at this, and this is the form that I want you to focus on, it's actually a fair value gap. Price comes to this fair value gap and react from it, either creating a change of character or a break of market structure. And the second form is the one that I want you to focus on, okay? It's the rebalance. What I want to see is I want to see price coming into a fair value gap, and I want to see a reaction from there causing a change of character. Price comes here. This now is my intermediate term low. Price goes up, comes down, mitigate anything in here. That's my short-term low. That's the one. This is the one as same as here. But there's no need to have a short-term low here. So you see this intermediate term low, price react, price comes down to create a short-term low after that. When I show you some examples, it's gonna be more clear. If we look at this example right here, we can see that price was coming down. Price reached this point. There was nothing on the left. Price give a retracement. You see there's no fair value gap, nothing. There's nothing in here. Price comes here and goes up. See aggressively, comes down, create a short-term low here and goes up. You see that there is no fair value gap here. That means this is a short-term low. It was not an intermediate term swing. Why? Because there's no fair value gap here. So now we have short-term low, and an intermediate term low in between. That's the first condition. When it comes to the second condition, what we have now is the price going up. There was a sweep here, but somehow it's not showing. After the sweep, we see an aggressive move with a displacement right here, breaking market structure, this right here, and leaving a fair value gap. Eventually, price comes up, fill this fair value gap here for the first time, and here for the second time. This is now an intermediate term high, and similarly here. But I always take the upper one. Take this one. So this is my intermediate term high, but I was just showing this just for the explanation. But you can see, this is an intermediate term high, and this is also the same. After that, price comes down to fill this fair value gap. Then that's also an intermediate term low. So whenever price goes to a fair value gap and react from there, that's going to be our intermediate term swing. As easy as this. Even though the concept is easy, but it has a lot of uses, and it can be so beneficial for you when it comes to market structure analysis. So now, if I want to put it in a simple way altogether, then I would say a long-term high is when you have a resistance or a POI on the higher time frame, and then price comes and react from there with a break of market structure, a very aggressive movement, then that's confirming this is a long-term high. Okay, price comes down and then leaving a fair value gap here. This high comes here, now mitigating this fair value gap. That means this is a short-term high, so we don't really pay attention for this. And price also come again. Let's say there's now this is liquidity. This is also a liquidity, relative equal highs. Eventually, it's gonna take those relative equal highs into the fair value gap, and that's what happened here. That's the perfect scenario, as I taught every time in my YouTube channel. This is my favorite model. Now, price comes into the fair value gap and also react from there with a change of character. This is now my intermediate term high. It's confirmed. And if you want to have more confirmation, what's gonna happen after the break in market structure is price will retrace and it's gonna create a swing failure. Always for this intermediate high to be valid, is gonna be followed by a swing failure. And what is a swing failure? It's basically a swing that failed to close or even like just go above this high. This is an intermediate high. This is a swing failure because it couldn't go above this high and started to go down, breaking this low. So this is a break of structure. And always you will have an opportunity to enter here on this intermediate term high to go short, and you will also find a better opportunity to go short from the swing failure. The swing failure is always going to have this type. So let's say this is the swing failure, this is the top of the swing failure. Most of the time there will be an order block at the top of the swing failure and a fair value gap, and you can enter from this fair value gap. It's always going to be like this, and then you see a break of structure here, break of structure here, and it's going to be followed. Even the big structure is going to be followed by break of structure. Why? Because we have our long-term high is confirmed here. Now, if I want to put it all together, I would say that the long-term perspective give you the narrative. So whenever there is a confirmed long-term high or short-term high, you need to think twice about your bias, about your narrative. If you are bullish and then a clear long-term high is confirmed, then you should be switching your bias to bearish, because price is mostly gonna come down. As this is confirmed now, this is a protection, this is a shield. When it comes to the intermediate term perspective, it's gonna give you the framework. It's gonna give you the structure. It's gonna show you where your area is valid and invalid. It's gonna show you where to put your stop loss. That's the point of intermediate term perspective. You're gonna know if you are in the right structure or not. And then at the end, the short-term perspective is gonna give you the entry. You're gonna know, you will know where to enter, and then you'll always switch to the lower time frame to find a better entry, to refine your entry for a better reward to risk ratio. Now, if we look at this example, basically price was coming down. There was this long-term high here, and price was going down. When is your bias will be changed? Just right here. You see this higher time frame old high sweep? There's an old high sweep. There's an old high right here, and it was swept. Now after this sweep and price is back to the range, you'll be switching your bias to bullish. And you can wait for a confirmation right here too. But after this sweep, you're kind of switching to bullish. But we have this fair value gap here, and what was happening is, you see this high tapped into the fair value gap and goes down, making this an intermediate term high. And what did we already say about the intermediate term perspective? It gives you the framework. So basically, this is an intermediate term high, it's a protection. And this is also the last clear swing before this movement to the downside. So that's gonna be our change of character, and it's not a normal change of character. It's not only the last swing before the sweep right here. No, it is an intermediate high because it was in a fair value gap. Price comes down, break this. So this break is giving me a higher probability indication that the trend will be changed, and I need to change my bias to bullish now. Most of the time, price will come down, fill a fair value gap here, or into this breakout block right here, and it's gonna go up from here. That's how we need to see the chart. You always want to look for this strong change of character. It's the intermediate high. When this one is broken, you'll want to switch your buys, not any change of character. Because if this was not an intermediate high, what's gonna happen is price is gonna go up. A lot of people will think this is a change of character, and maybe price will come down, show you a reaction here, but it's gonna go down, breaking all of those. But this is a strong indication. This is a strong confluence. Now I'm sharing this one more trick for you guys, because a lot of people are missing trades because of change of character. Basically, our classic change of character is this on the right. We want to see price moving to the downside. So basically, price was trending to the downside. We see a movement to the upside. Now, if price comes here, not breaking this low, and then break this high, this is not considered a change of character. What we really want to see is breaking above the last swing before the sweep. So you see the sweep here. Where's the last swing before the sweep? It's this one. So our change of character is going to be breaking above this, and price is going to close above. Remember, we need closure above, otherwise it's a sweep. So price will close above and then goes down into a fair value gap here, or balance price range, or a breaker block, or whatever, or into the OB2. You're going to enter here and price will go up. But a lot of times you don't see this. I mean, you still see it, but sometimes you miss a lot of trades and opportunities just because you're waiting for this. You're waiting for the last swing to be closed above, which doesn't happen always. On the other hand, what happens here is price create a high and then create a failure swing. Price doesn't close above this low right here, goes up, and then comes to the fair value gap. You're still thinking that, oh, there is no change of character yet, and price will go up. And you'll be like, oh my God, this doesn't work. ICT doesn't work. Smart money concept doesn't work. But what you don't know is that this is an intermediate high now. Why? Because there is a fair value gap here, and price was coming into this fair value gap and then showed a reaction. Price doesn't need to go below this point. Breaking above this point is now confirming that this is a change of character, and it is a strong confirmation. Price break above, you enter from the fair value gap. But if there was a fair value gap here that was not mitigated, then you can enter from here. But if everything was mitigated here, you can enter from here. This is a very important trick that you will see like almost every day. A lot of people in my Discord complaining that they miss a lot of trades because of this. And that's what I'm giving you now. An example of the same thing here. We can see that we had a sweep here, but then there was no change of character. So this is the sweep here. Where's my last swing? You could take this one, or you could take this one too. But both of them, you see there was no closure below this. But there was a fair value gap here that price went inside and react from there. But what happened here is price doesn't close above this. If price goes above and then go down, I'll be looking for this swing as my change of character point. But it doesn't happen. A lot of people will say, okay, I'll be waiting for this swing now to be taken for a change of character. But what you can do instead is, now this is an intermediate term low. Why? Because there was a fair value gap. Price mitigated that fair value gap. Price comes, failure swing here, and price goes down. When closing below this point, that means that there is a change of character, which happens here. You see a clear closure below. There's nothing mitigated in here. There's an OB with fair value gap here that was not mitigated. You can enter here and you see the movement after that. That's all for my today's video. I hope you guys like it. If you guys would like if any of you guys need a one-on-one mentorship, then contact me on my email. And then don't forget to leave a like and a comment. That's it for today, guys. Thank you so much, and I wish you the best.